Ladies and gentlemen, welcome back to the channel for your daily dose of the stock market is kooky. Just playing, we live in a perfect market where everything is accurately priced and nobody lies to you. Again, just kidding. CPI this morning across the board came in slightly hotter than expected. As I've said many times before, CPI is really not a big catalyst for markets. We are trading lower on the S&P on basically all of your major indexes. The Russell is taking this a bit harder. The Dow's taking this a bit harder than the headline S&P or the NASDAQ, which would make sense if we're getting data that suggests the Fed's not going to be cutting rates as aggressively as we previously thought. But not so fast, because initial jobless claims for last week came in way higher than expected, and that's really what's giving you the marginal weakness in markets today. So first up, let's start with CPI. Core month over month came in at 0.3%. The estimate was 0.2%. So that was slightly hot. Year over year, core came in at 3.3%. The estimate was 3.2%. Again, slightly hot. Month over month, CPI headline came in at 0.2%. The estimate was 0.1%. And year over year, CPI came in at 2.4%. The estimate was 2.3%. And if you really wanted to get negative here on CPI, you would be negative on super core CPI, because this surged 0.4% month over month, the highest since April, driven by surging cost of professional medical services and record high auto insurance. And you could see the jump over here on month over month core is... let's blow this up as much as we can. Is pretty extreme. I mean, that's a pretty large jump. But the real story is U.S. jobless claims that jumped to a year high, partly boosted by Hurricane Helene. But again, not so fast. Liz Young-Thomas says weekly jobless claims spiked. Initial and continuing claims came in at 258,000 and 1.861 million respectively, significantly above the consensus for 230,000 and 1.83 million. Weakness was concentrated in the Midwest and South. Parentheses, weather, strikes, but tough to hand wave this away. Because again, these estimates were already incorporating the damage that Hurricane Helene was going to do to this week's initial jobless claims report. Like, it was already factored in. Helene was not something that happened yesterday that we just, abruptly had to price in. Like, we've had a week to think about what this will do to the labor market. And I think Renaissance Macro Research provides a great take as well. He says initial jobless claims were not just about the hurricanes. We saw big NSA increases in California, Ohio, and Michigan. Shout out Michigan, my home state where I'm filming this video, for the week ending October 5th. And you can see here, there was definitely some jumps in the states in which that experienced a lot of the, hurricanes. North Carolina jumped from 3,000 the previous week up to 11,000. A lot of that, I would argue, is definitely due to the hurricane. You can also see that Florida jumped from 5,500 to 9,300. I would say some of that definitely has to do with the hurricanes. You could see Michigan, though, jump from 6,700 to 16,000. California went from 38,000 to 43,000. That's a big increase. Indiana as well went from 3,200 to almost 6,000. Washington was higher. Let's see. The other states have low populations. So out of the states with higher populations, the numbers actually did go up quite a bit. Mark Newton says there is a notable drop in two-year yields post-jobless claims and CPI, shows that markets are very much favoring labor market data over inflation, something I've talked about extensively here on this channel. Inflation is really not a catalyst anymore. It's all about the labor market. He goes on to say, and why wouldn't you with sluggish rent data and OER distortions? Two-year yields below, up against very important near-term resistance. Axios says, quote, the job market is frozen in place. Companies are hesitant to shrink or grow their payrolls for fear that they might be caught if the economy revs up or unexpectedly slows down, and workers seeing this tough hiring environment are less likely to quit their jobs. I mean, I've seen this on Facebook posts, I've seen this from, people in real life talking about the labor market, that it's hard to find a job. Now, granted, it's probably not hard to find low income disposable jobs. It's probably not too difficult to get a job at McDonald's right now, for an example, because the turnover rate is high at some of those jobs. But trying to find good jobs, trying to find jobs that actually can support a family, that is a completely different story. That's where I think a lot of people are seeing the troubles. Zero Hedge on X says, why the VIX is acting bananas. Look at the events that are now in its 30-day window. You had CPI today for September that came in October 10th. October non-farm payrolls that come in November 1st. Election, which is the 5th. FOMC, which is November 7th. And another CPI report for October, which comes in November 13th, all roughly within the next month or so, and that's helping to keep the VIX elevated. Again, this has been one of the strangest things that has happened in recent years, where markets continue to hit all-time highs, and people are excited, yes, but we're all just looking around like, okay, what's about to happen? Something's about to happen. The VIX is sitting at 21.21 today. Yet markets are still within just a couple of points of a new all-time high. You have not seen that in my investment lifetime that I can recall. I've never seen the VIX spike and stay elevated like this just because, basically for no reason. Now here you can see on the day today, as I previously explained, the Russell 2000 is taking it the hardest today, down almost 1%. The Dow is down 1/3 of 1%, the second worst performing major index. The S&P is down 1/4 of 1%, and the Nasdaq is down 1/10 of 1%. Trump is set to propose a new tax break on car loan interest. So basically how you can write off the interest paid on a mortgage, for an example, you're going to be able to do that with cars also, which is helping to give Tesla and other car makers a decent jump here in afternoon trading. Another big story today is the again spike in oil. Oil is up $2.50 a barrel today, up 3.5%, sitting at $75.83 for WTI crude. And this really has to do with the pending retaliation against Iran coming from Israel, in which we're getting more news on that today. Notably, it was reported about 2 hours ago that Israeli Security Cabinet expected to approve Israel's response plan to Iran, according to the New York Times. There was also talk today, really late last night, that Biden urged Israel not to attack oil or nuclear facilities in Iran, and Israel said it was really a prime opportunity to do so. So that is partially what is causing the spike in oil. Now, the reason this Middle East situation is so important is it really has nothing to do with, human lives. It has nothing to do with infrastructure, nothing to do with really trade between the countries. And I know that sounds harsh, like I don't want a war any more than anyone else does. But from a financial perspective, Iran is a major oil producer. That's the problem. If you do see oil spike, it has a dramatic impact on people's spending behaviors when the price of gas goes up. So that's the I guess economic correlation to this Middle East situation. It could be a nothing burger. We could see oil fall after Israel strikes Iran. It just depends on what they hit and what kind of damage is done, so on and so forth. Or this could be I know people don't like black swan event because that's what nobody can see coming, but a gray swan event, something that could happen, that has a low likelihood of happening, something markets really don't prepare for. And if oil were to go through another major spike, that would at the bare minimum be a gray swan event and would cause a lot of economic damage. And if you ever wanted to know who a party pooper is, well, it's Fed Bostic. Fed Bostic says, this choppiness to me is along the lines of maybe we should take a pause in November. I'm definitely open to that. He also says more clearly, I'm open to not moving at one of the last 2 meetings if the data comes in as I expect, which is really helping to throw cold water on the already rising bond yields, which is selling in actual bonds. So you can see via some of these comments from Fed Bostic, 10-year treasury yields are up about 4.5 basis points to 4.11%. And this, I think, is very important as well right now. Ever since the Fed cut rates 50 basis points, when they were instinctively trying to help the labor market, they've started to hurt the labor market in a pretty dramatic way, because most lending revolves around the 10-year treasury. So borrowing costs have actually jumped almost around 60 basis points, almost 70 basis points, depending on what part of the curve you're looking at. And that has not done any favors to an already slowing economy. So in fact, each day 10-year treasury yields continue to go higher, and the longer they stay at these elevated levels, the odds of a recession are also increasing. Now, tomorrow morning, we really kick off the major start of earnings season. Tomorrow morning, we have earnings from JP Morgan, Wells Fargo, BlackRock, BNY, Fastenal, Bank 7. So JP Morgan specifically and Wells Fargo are going to give us a lot more insights on the consumer, potentially what default rates are looking like, what bank balances are looking like, how people are spending their money. And that is really going to tell us a lot about the consumer. So at a time in which the economic data is a bit on the weird side, we're not getting the most accurate economic data, one thing we can count on for accuracy is company earnings. So I think a lot of Wall Street, basically everyone's going to be paying attention to the bank earnings, and whatever they say is going to be very important in really reaffirming the soft landing or something much worse. Like if the banks come out tomorrow and they say everything's just fine, the consumer's just doing dandy and credit is just fine, then it would be hard to not be incrementally more bullish on markets. I'm not going to say that that's going to alleviate all of the problems by any stretch of the imagination, but if banks say everything's fine and they are legally obligated to be honest via earnings, it's hard to say that wouldn't boost my confidence at least a little bit in a potential soft landing, because that's also something I've explained to you guys many times here on the channel. Hopefully I've been crystal clear on this. The Fed is incentivized to lie to you when it makes sense for their dual mandate. The government has no responsibility to be honest to you. The only place that really is obligated to be honest with you is companies and company earnings, because imagine if a CEO just blatantly lies to markets, like, you will go to prison for that. You will. So you can't lie to investors. You can make things look a little bit better, right? But you're not able to just lie to investors the way that maybe some of the data we're getting is lying to us, or maybe the ways the Fed is lying to us, right? So that's why this earnings season will be so important. If we actually look at markets today, given all of really the bad news that we got, the fact that the S&P is only down 0.15% is actually pretty damn remarkable. You could see big tech, specifically Nvidia and Amazon, really trying to pave the way for the markets to hold up. Nvidia is up 1.5% today. Amazon is up over 1%. Google to a lesser extent as well. Google is up 1/3 of 1%, whereas Microsoft is down 1/3 of 1%. Meta's down almost 1%, and Apple's down 1/2 of 1%. Without some of this big tech strength, yes, markets would be lower. You can see the RSP, which is the equal weight S&P. If you just look at all 500 companies and the average performance there, you're actually down 1/3 of 1% today. So that's a little bit more accurate perception of what's going on in markets today. And I have to say, from a technical basis, the markets actually don't look too bad at all. It looks like markets want to continue to go higher, but again, it's really going to depend on those bank earnings. And as I've explained in other videos, I do think there's been a fair bit of capitulation over the past couple of days where investors are just throwing up their hands. They're saying, we have to start buying. Markets are just not gonna come down, and that usually leads to a reversal. So we'll see over the next couple of trading days if we actually do start to see that reversal. And in my opinion, I think markets are vulnerable for a rapid correction if earnings do start to come in worse than expected. And I think that's something we should all prepare for. CNN's Fear and Greed Index is sitting at 72 today, unchanged from yesterday. Market momentum is greed, stock price strength, extreme greed, stock price breadth, extreme greed, put and call options, greed, market volatility is neutral, and safe haven demand is in extreme greed, as well as junk bond demand being neutral. The latest AI investor sentiment survey does show bullish investors ticking upwards to 49.0%, neutral investors rising to 30.4%, and bearish investors falling to a multi-month low of 20.6%. Again, in line with that capitulation that it looks like we are seeing in markets. The percent of stocks currently trading above their 50-day moving average is falling a bit today, down to 53.96%. You have about 1.5% of all stocks breaking below their 50-day moving average. So not a terrible day, and I'm actually surprised it's not a worse day, but definitely not a good day by any stretch of the imagination either. With that said, let me know what you think about this information down below in the comments section. You guys have a fantastic rest of your day, and I will see you in the next one.